So the crystal ball is this gray area. There's the cool off point. The how I got this was just follow this run from yesterday, because the CPI run, I thought, so basically the thesis is based on the fact that people who follow this run got out. That's the cool off point. That's people who follow this before the run, or like with this run, not necessarily here, because this one is basically flat. So some people got out, but not enough to profit. So if we follow this line up to here, to up to PPI, I would say that a lot of people, because of CPI was so positive, or positive news, that a lot of people follow through the PPI, and I almost did that myself too. Was going to follow through the PPI, but I didn't. But anyway, so the way I got this point for the closing was first follow that from the previous trend with Fibonacci, not this one, but this one starts here, ends there. And the 50% is usually the trading point, the retract point. So that's the bottom. The top is the closing of here, which people stop buying, I guess, from here. They just, or people who bought it from here, they sell it back. So that's the range of this point. So more or less from here to here is the closing range for cool off. And it could even cool off above here, or even slightly less here, but that doesn't mean that it's a sell-off, because it's still very strongly at the 38% of the Fibonacci on the run itself. Going forward, I think it'll just bounce between here and probably maybe go down even lower, open lower tomorrow. Not sure how low. It could go down to this level, the lower of the day before, or it could pop back up to where along the 200 EMA, it seems like it. So it could pop back up there, or something totally strange might happen overnight. But what I'm guessing is the range could be around here from this tomorrow's pivot, based on current price, tomorrow's pivot to today's pivot. Like around here is the opening range, and after the consumer confidence or the sentiment, I think it'll go up, because right now people are kind of uncertain about the direction, especially the traders. Like, look at this. Uncertain if we're out of the bear market or going back to the bear market whenever it hits the resistance. There was a 17 and there's 25 and so forth. So any small indication to the upside will, I think, reset the downside, especially after the inflation moderating. And I got this closing level around, I think around here, around 12 in the morning, I think, but somewhere around here, because I was actually this is the, what is this? This is the put. Yeah, this is the contract that I have, but I was actually looking at both of them, the put and the call, as a hedge reference. Yeah, this is the call. So it helps to define the range of how wrong I am, if I am wrong. So my indicator was this S2 here, or R2 here. If it goes past here, then I'm wrong. So I should get out, even if on the put it looks different. that was my hedge indicator. Uh, so when it didn't, I think around 12 was like it got rejected there. So my decision was that it was going to go down. So how far will it go down? First of all, I use the IV, the implied volatility. There's like some stupid equation that I use. Is the price level at that time times the percentage of the IV, implied volatility, of the option times the square root of remaining trading days, not the option expires. So for example, if the option expires on Friday and today's Thursday, that's 2, square root of 2, not 1, where the DTE would say just 1 day, right? But it includes the trading day that you are trading in. So there will be 2 days, and divided by square root of 365. That's the how much the option is the implied volatility is calculated in. It counts 1 year. So you want to divide that, and you get certain number. And if I'm trading on that day, I would divide that number by the amount of number I multiplied by previously. So for the same example, today's Thursday and the option expires on Friday, then I would multiply it by a square root of 2, and then after the whole equation, what I got, I would divide that by 2. That's the equally weighted division. So it's not accurate, but it gives a certain sense of how far the price would move within the bell curve during in that day. And 68% of the time, the price moves within the standard deviation. With no standard deviation. So it's pretty much right. And with that, I had a conclusion of it'll move about $3 today from from the open. So I will subtract that number I get to the opening amount, which is 422. So roughly minus $3 is 419. So it all fits with all that thing. So that's how I get this around here, if I were to believe that it was going to go down.